Hello, Stephen Koukoulas here, Economist-in-Residence in Zagga, with our regular updated video on the economy. And yes, we've seen the Reserve Bank hike interest rates again for a second time in a row, February and now March, lifting the cash rate to 4.1%, and it's all about inflation. We know that even prior to this oil shock, inflation was a little uncomfortable for the RBA. Now there's a debate going on about the oil shock, about whether the mechanical pass-through of higher oil prices, petrol prices into the inflation rate, that's obvious. But will it be sustained? How long will the conflict last? Will we be in a position in a few weeks or a month or two where the Straits of Hormuz are open again, the oil's flowing through, and we get the oil price back at $70 a barrel and the inflation effect washes out? Who knows? And the Reserve Bank were good enough to acknowledge that as well. But for the here and now, they thought that with the economy and the inflation rate being too high, the rate hike was needed. So that's going to put a lot of pressure on the economy. And I'm a little unsure because I look at the other news that's come out. And as we said in the last video, the GDP numbers through to the end of 2025 were good. 2.6% growth. But we've had a range of economic indicators for the start of 2026, and they've been really disappointing. I think that some of the momentum in the economy is starting to falter, and I'll run through a list of a few of them. Household spending, which is a huge part of GDP, what you and I spend every day at the grocery shop, at the pubs and clubs, and on insurance and rent and all those things. Household spending was negative in December, a very small rise in January, and a lot of the internal data from the big banks shows another very weak result for February. So we consumers are hunkering down under the inflation rate, which has gone up and impacted our incomes. But wages growth is also quite moderate at the moment. So that's actually a constraint on activity. The other soft part of the economy is building approvals. And again, I've been pretty upbeat about the housing construction sector. I thought that we'd be looking for a pretty solid upswing through the course of the next couple of years. Now, unfortunately, that optimism that was there a few months ago has been unwound because building approvals numbers have actually fallen 15% from where they were in September. So yes, a lot of that is apartments and high-rise construction activity. They're very volatile. There's obviously a large number of items in 1 month and they can drop out. But we are still a long way away from the 20,000 building approvals we need per month to get to anywhere near that, 1.2 million dwellings that the government's been wishing for. And in fact, we're hovering more around 15 to 16,000 per month on building approvals. So again, that housing shortage is going to continue while we're not building enough houses. And just on that latter point, house prices, well, there's extreme volatility there. Sydney and Melbourne are really weak. Prices are flat to slightly down in Sydney and Melbourne, where the boom cities of Perth, Brisbane, Adelaide are still booming, although the rate of increase is starting to cool off a little bit there too. So the housing market's doing pretty well. Rental vacancy rates are low. The first home buyer 5% deposit scheme has sparked a bit of demand at the sort of lower half of the market in terms of lower half of prices, and that's an issue too. I mentioned a couple of other good points to think about the economy too. Productivity, which has been the bugbear of the economy, is starting to lift a little bit from a low base, and we need more productivity. Business investment is ticking higher, so that's an important part of the economy too, and hopefully these rate hikes don't crimp that better news that we've seen from business investment activity. But we've got this huge problem in the global economy. And as I said, I can't put my hand on my heart and say when it's going to end. Nobody can. But when it does end, hopefully sooner rather than later, the oil price and the distribution of oil returns to somewhere near normal. One final point, we're not that far away from the federal budget. It's on the 12th of May, so stay tuned for more Zagga updates about the budget as we get closer to the 12th of May. But I'm pretty sure we're hearing lots of noises from Canberra, from the Treasurer, Jim Chalmers, that they want to have a reforming budget. And if they deliver it, 3 cheers from me. We do need some tax reform. We do need a tighter rein on government spending. We do need to get that budget deficit, which admittedly is not huge, but we still want to get it back towards balance, dare I say a small surplus, and that will help take some of the steam out of the economy if they can deliver. So there's a lot of expectations on Jim Chalmers and the government as they come up to their budget in May. Let's hope they deliver. he's got my best wishes when it comes to reforming tax and, as I said, lowering the budget deficit and, dare I say, in a good period, maybe delivering a budget surplus. So thanks to all the team at Zagga. Onward and upward. Let's hope that we can get the economy through this interest rate tightening phase sooner rather than later. Thanks very much.